Hey everyone, in this video I'm going to talk about the most common mistake I see beginner investors making every day in the market today. Hi everyone, my name is Parkev Tatevosian. I'm a professor of finance, and every semester I ask my students, what do you think about this stock or that stock, right? And the most common thing I hear from students is, oh, I don't want to buy that stock. It's selling at $200 per share. It's too expensive. And in this video, I'm going to talk about why saying that is a mistake, or thinking that is a mistake. Because what the stock price is selling for, it's easy to get that mixed up with the valuation. Those are two different things. A stock price can be selling for $200 per share and it could still be cheap, or a stock price can be selling for $1,000 per share and it could still be cheap. You might say, how can $1,000 be cheap? That doesn't make sense. Well, let me go through a few examples with you and share with you in these charts why and how to correctly perceive the difference between a stock price and a stock valuation. So let's get right into it, starting of course with one of the most popular stocks in the stock market today, and that is Tesla. So Tesla's stock price I have here on the top chart is $243 per share. This is after the stock has been split several times. Now, stock splits are a whole nother story. I'm not going to get into that. But what this shows is just Tesla's stock price. And underneath it, what I have is Tesla's price to earnings ratio. Price to earnings ratio. You'll notice the stock price is 243, but the price to earnings ratio is 50. That means you're paying 50 times the company's earnings that are expected in this coming year. So this company, let's say, is expected to earn a certain amount of profits this year, and you're paying 50 times those profits to buy the company. Does that make sense? 50 times its profits to buy the company. Let me share with you another example. Next, I have here Palantir Technologies, another popular stock in the market today. Palantir Technologies stock price is $14 per share, just $14. So you might be tempted to say, oh, well, that's a cheap stock. It's only $14 per share. Aha. But there's where we face some difficulty, because Palantir is actually more expensive than Tesla. Yes, you heard me correctly. Palantir is more expensive than Tesla, despite the fact that Palantir is selling at $14 per share and Tesla is selling at $243 per share. That's because Palantir stock is selling at a price to earnings of 52, where Tesla is selling at a price to earnings of 50. Is that making sense now? The stock, whether or not it's expensive, depends on its price to earnings ratio, or price to free cash flow ratio, or price to sales ratio. So whether or not a stock is expensive is in relation to what you're getting in return. That's the key. Let me share a couple more examples here. Next, I have Amazon stock. That's selling at a price of $126 per share, but you're getting it at a price to earnings of 41. So this is cheaper than Palantir and Tesla. And finally, I have the Chipotle. Its stock price is selling at $1,848 per share, but you're getting Chipotle at a forward price to earnings of 35. Just 35. So now I hope I can make a statement that won't sound ridiculous to you. Okay? Where before you watch this video, if you heard me say something like this, you might think this professor is crazy. But now, hopefully, after I've shared with you the contents of this video, you can understand this final statement. And that is that Chipotle stock is the cheapest out of all the 4 stocks I shared with you in this video. Even though it's selling at $1,848 per share, a price that's way higher than all the other ones, a price that's higher. but the stock itself, it's cheaper than all the rest because you're getting it at a forward price to earnings of 35, whereas Amazon is at a forward PE of 41. Palantir is at a forward PE of 52, and Tesla's at a forward PE of 50. So the reason Chipotle is cheaper than all the rest is because you're getting it at the lowest price to earnings of 35. So that's what makes a stock cheap, and that's the number one mistake that I see many investors making, is looking at a stock price to tell themselves whether or not a stock is expensive or not. Right? It's not the stock price, it's the price ratios, the price to earnings, price to free cash flow, price to sales, that determine if a stock is cheap or not. So hopefully in your decision making going forward, you will not just look at the stock price from now on, you'll look at some of the ratios, the price to earnings, the price to free cash flow, and the price to sales are three of the most common ratios that I consider every day when I'm evaluating stocks. Once again, thank you so much for watching. I hope you've learned something in this video. I hope you've gained some value, and you probably have if you've made it this far. So please go ahead and hit the subscribe button. You can get access to more excellent videos like this one, and all for the excellent price of free.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.